Listen very carefully to what I'm about to tell you, because what happened yesterday in the silver market was not normal volatility. It was not natural price discovery. It was not organic selling pressure from panicked retail investors. What happened between 10 a.m. and 1 p.m. Eastern Standard Time on January 27, 2026, was a calculated, coordinated attack designed specifically to separate you from your positions before the next leg up. And if you don't understand the mechanics of what they just did, you're going to fall for it again. You're going to get shaken out right before silver goes to $200. Today is Monday, January 27th, 2026, and I need to walk you through the forensic details of the most violent silver manipulation event I've seen in over a decade. At exactly 10:17 a.m. yesterday morning, silver was trading peacefully at $113 per ounce. The market was consolidating after breaking through $110 earlier in the week. Everything looked normal. Retail investors were cautiously optimistic. The momentum was building. And then, in a matter of minutes, silver exploded to $117, a $4 move in less than 30 minutes. The algorithms went crazy. Retail traders were celebrating. Social media was flooded with silver to the moon posts. People were calling their friends, telling them to buy. It felt like the breakout everyone had been waiting for. But here's what you didn't see. Here's what was happening behind the curtain while retail was celebrating. The large commercial banks, the market makers who control the COMEX, were watching the order flow. They were seeing massive retail buying come into the market. They were seeing stop-loss orders stacked above 115. They were seeing margin calls being prepared for short sellers. And they were seeing an opportunity. An opportunity to do what they always do when retail gets too excited and too leveraged. They were preparing to pull the rug. At 10:52 a.m., exactly 35 minutes after the spike to $117, the attack began. Someone, and we can make educated guesses about who based on the size and coordination, dumped what appears to be over 15,000 contracts, roughly 75 million ounces of paper silver, into the market in a coordinated wave. This was not a seller trying to get the best price. This was not a fund rebalancing. This was a tactical nuclear strike designed to trigger a cascade of algorithmic selling and stop-loss liquidations. The price didn't just fall, it collapsed. Silver went from $117 to $110 in 8 minutes, then from $110 to $105 in another 6 minutes. And finally, in a capitulation flush that took everyone's breath away, it crashed to $102 in the final desperate moments. $117 to $102, a $15 move, a 13% crash in less than 3 hours. Billions of dollars in long positions were liquidated. Margin calls went out across every major trading platform. Retail traders who had bought at $115 with tight stop losses were forced out at $108, $105, $103. The exchanges were overwhelmed. Trading platforms crashed from the volume. And through it all, silver itself, the physical metal sitting in vaults around the world, didn't move. Not 1 ounce changed location. This was entirely a paper market phenomenon. And here's the part that should make your blood boil. While retail was being liquidated in panic, while small traders were watching their accounts get destroyed, the same entities that caused the crash were buying. They were accumulating the physical delivery contracts at 100 kilos that they're going to settle at $150 next month. They shook the tree, caught the falling fruit, and left retail holding nothing but losses and trauma. By the end of the day, silver had recovered to $111. As I record this on Monday morning, it's trading at 112s. The entire crash has been erased. It was a fake out. It was a trap. And thousands of traders fell into it because they didn't understand the game being played. So let me explain the game to you right now, because this is going to happen again and again and again as we move toward $200 silver. And if you understand the playbook, you won't be a victim. You'll be positioned to profit. The first thing you need to understand is why these violent washouts happen at all. It's not random. It's not chaos. It's a business model. The large commercial banks that act as market makers on the COMEX have a fundamental problem. They're short the market. They have sold more paper silver than they can possibly deliver. Their business model for decades has been to sell paper contracts to investors and hedge funds, collect premiums, and then use their market power to ensure they never have to actually deliver physical metal at a loss. This worked beautifully when silver was trading in a narrow range between $15 and $25. They could manipulate the price up and down within that channel, scalping profits from retail on both sides. But now we're in a structural bull market. Silver has gone from $20 to $117 in just over a year. Every time the price moves higher, their short positions lose money. Every dollar that silver rises costs them hundreds of millions in unrealized losses. And unlike retail traders who can just close their positions and walk away, these banks are trapped. They're too big. They have too many contracts. If they tried to cover their shorts by buying back all their positions, they would drive the price to $300 immediately and bankrupt themselves in the process. So what do? They can't cover. They can't deliver the physical metal because it doesn't exist in the quantities they've sold. Their only option is to manage their exposure by periodically crashing the price, triggering mass liquidations, and using those liquidations to close out some of their worst positions at favorable prices. This is what happened yesterday. This is what happens every time silver gets too far too fast and retail gets too confident. Here's the technical setup they exploited. In the run-up to 117, retail traders were piling in with leverage. Brokers allow you to trade futures contracts with only 10% to 15% margin. This means if you have $10,000, you can control $100,000 worth of silver. It amplifies your gains, but it also amplifies your losses. And critically, if the price moves against you by more than your margin buffer, you get automatically liquidated. The broker closes your position to protect themselves from your loss exceeding your account balance. The banks know exactly where these margin liquidation levels are because they have access to the order book. They can see where the stop losses are clustered. They can see where the leveraged longs are vulnerable. So they wait. They wait until retail is maximally long, maximally confident, and maximally exposed, and then they strike. They dump massive size into the thinnest part of the trading session, typically right before lunch in New York when liquidity is lowest, and they trigger a cascade. Here's how the cascade works. When silver drops from 117 times to 115s, it hits the first layer of stop losses. These are the tight stops from day traders and momentum chasers who bought at $116. Their sells hit the market, pushing the price to 113. This triggers the next layer of stops from people who bought at 112. Their forced selling pushes it to $110. Now the margin calls start going out. Traders who are leveraged 10 to 1 and bought at 110 are suddenly underwater by 5%, which wipes out half their margin. The broker liquidates them automatically. This selling pressure pushes silver to 105. Now the real panic sets in. Everyone is selling. The algorithms that follow momentum flip from buy to sell. The technical traders who worship the charts see support levels breaking and add to the selling. And in the final flush, silver hits $102, triggering every single stop loss and margin call between $110 and $100. The banks, who caused this entire cascade with their initial dump, are now buying everything at $100 to $105s. They're covering their expensive short positions from $80 and $90 with cheap positions at 102s. They're resetting their exposure, taking profit, and preparing for the next leg higher. Meanwhile, retail is shell-shocked, demoralized, and in many cases completely wiped out. This is not a conspiracy theory. This is documented. JP Morgan paid nearly $1 billion in fines for doing exactly this in the gold and silver markets. They were caught spoofing, placing fake orders to manipulate prices and trigger stop losses. The only thing that's changed is they've gotten more sophisticated about how they do it. Now, here's the critical insight that most traders miss. These washouts are not signs that the bull market is over. They're proof that the bull market is real. Think about it logically. If silver was going to crash back to $30, why would the banks need to engineer these violent fakeouts? They would just let it fall naturally. The fact that they have to manufacture these crashes, the fact that the price immediately recovers afterward, tells you everything you need to know. The underlying bid is so strong that the only way to shake people out is through violent, coordinated manipulation. Look at what happened after the crash. Within hours, silver was back at $108. By the close, it was $111. This morning, it's $112. The physical market didn't blink. Dealers are still sold out. Premiums are still 15% to 20% over spot. Asian buyers are still paying $125 to $130 for physical delivery. The paper market crashed, but the real market didn't care. This tells you which market is real and which market is fiction. And here's the really important part. This is going to keep happening. As silver moves toward $150, $175, $200, you're going to see more of these attacks. They're going to get more violent, not less, because the banks are getting more desperate. Every $10 that silver rises makes their position worse. They're going to pull out every trick they have to shake weak hands out of the market before the real move happens. And if you don't understand this, if you're trading with tight stop losses, if you're over-leveraged, if you're watching the minute-by-minute price action on your phone, you are going to get destroyed. You're going to sell at $100 and watch it go to $200 without you. Let me explain the proper way to think about and trade this market, because there's a right way and a wrong way, and the difference between them is the difference between wealth preservation and financial ruin. The wrong way is day trading. The wrong way is trying to catch every move, trying to time every dip, trying to be clever and trade around your position. Day trading is where retail gets slaughtered. Day trading is where the algorithms eat you alive. Day trading means you're playing their game on their turf with their rules, and you will lose. Here's why day trading doesn't work in manipulated markets. The banks have better information than you. They see the order book. They know where the stops are. They have direct lines to the exchanges. They have algorithms that can execute trades in microseconds. You're sitting at home on your laptop with a 500 millisecond delay on your price feed. You cannot win that game. It's like playing poker against someone who can see your cards. The game is rigged against you by design. But more fundamentally, day trading makes you focus on the wrong time frame. You start obsessing about hourly candles and 15-minute charts. You start reacting emotionally to every $2 move. You start placing tight stop losses because you're afraid of losing money. And those tight stop losses are exactly what the banks are hunting for. They can see them, they know where they are, and they engineer these crashes specifically to trigger them and take your position. The right way to approach this market is with a completely different mindset. You need to think like a central bank, not like a day trader. Central banks don't trade silver, they accumulate silver, they buy physical metal, they put it in a vault, and they forget about it for years. They don't check the price every day. They don't panic when it drops 10%. They understand that they're making a multi-year bet on monetary debasement, currency collapse, and the failure of the fiat system. And in that context, whether silver is $102 or $170 today is completely irrelevant. What matters is where it will be in 2030. This is the mindset you need. You're not trading silver. You're accumulating a monetary asset that will preserve your purchasing power as the dollar is deliberately destroyed. You're not trying to make 5% this week. You're trying to not lose 50% of your wealth over the next 5 years as they implement Plaza Accord 2.0 and crash the dollar. When you frame it that way, the day-to-day volatility becomes noise. It becomes irrelevant. So here's the protocol. If you own physical silver, you do nothing. You hold. You don't sell when it crashes to $102. You don't sell when it spikes to $117. You hold through all of it because you understand that physical silver is your insurance policy against the currency debasement that's being engineered right now by the Federal Reserve. If anything, when you see these manufactured crashes, you buy more. You use them as gift opportunities. Yesterday, when silver hit $102, that was a gift. It was a chance to buy physical metal at a 10% discount from where it was trading just hours before. The smart money wasn't selling, they were backing up the truck. If you're trading paper silver, futures contracts, or options, you need to be extremely careful about your position sizing and your stop losses. Never use tight stops. If you can't afford to weather a 15% to 20% drawdown, you're over-leveraged. Cut your position size, use wider stops, or better yet, don't use stops at all. Trade with cash, not margin, so you can't get liquidated. And accept that you might see your position go underwater temporarily. If you bought at 115s and it went to $102, and you didn't have a stop and you held, you're now back to $112 and probably green by next week. But if you had a tight stop at $110, you got taken out at $110, you took a loss, and you're not participating in the recovery. The banks know that most retail traders can't handle the psychological pain of watching a position go 10% or 15% against them. They know that most people will panic and sell. This is why they engineer these moves. They're exploiting human psychology, fear, and greed to steal your position. The only way to win is to not play their game. Don't day trade. Don't over-leverage. Don't use tight stops. Just accumulate and hold. Now let me give you the bigger picture context for why these manipulations are happening with increasing frequency and why they're going to continue. It all connects to what's happening at the macro level, at the central bank level, at the currency war level. And this is where the story gets truly terrifying, because what I'm about to explain to you is going to change how you think about your savings, your investments, and your financial future. On Friday, January 23rd, 2026, something happened that barely registered in the mainstream financial media, but sent shockwaves through the upper echelons of the global banking system. The Federal Reserve Bank of New York made a series of phone calls to the primary dealer banks, JP Morgan, Goldman Sachs, Citigroup. These weren't social calls. These were what's known in the industry as rate checks. The New York Fed called and asked a simple question. What's your current price for dollar-yen? Now, to most people, this sounds completely mundane. Of course, the Fed knows what the exchange rate is. They have Bloomberg terminals, they have direct data feeds, they can see the price to 5 decimal places in real time. So why are they calling dealers to ask for a price? The answer is because they're not actually asking for information, they're sending a message. A rate check from the New York Fed is the financial equivalent of racking a shotgun in a dark room. It's a signal. It means intervention is imminent. It means the Fed is about to enter the currency markets with massive size to manipulate exchange rates. And it means that anyone positioned on the wrong side of that intervention is about to get destroyed. And the last time we saw this kind of coordinated signaling was not in 2020 during COVID. It was not in 2008 during the financial crisis. To find a historical parallel, you have to go back 40 years to September 1985 to the Plaza Accord. In 1985, the United States faced an almost identical set of problems to what we're facing today. The dollar was too strong. It was crushing American manufacturing. Caterpillar, Ford, IBM were hemorrhaging market share because American exports were too expensive. Emerging markets were defaulting on dollar-denominated debt. Congress was threatening massive tariffs to protect American jobs. Sound familiar? The solution was radical. The finance ministers of the G5 nations met in secret at the Plaza Hotel in New York and agreed to kill the dollar. They agreed to coordinate their central banks to sell dollars and buy yen and Deutsche Marks until the dollar collapsed. And it worked. The dollar crashed 50% over 2 years. American exports became competitive again, but the cost was enormous. The purchasing power of American savings was cut in half. Everything imported became twice as expensive. It was a stealth tax on every American who held dollars. Now look at 2026. We have a $36 trillion national debt growing by $2 trillion per year. We have interest payments on that debt approaching $1.8 trillion annually, more than we spend on defense or Social Security. We have a trade deficit of $1.2 trillion. We have a strong dollar that's making American goods uncompetitive globally. And we have a Federal Reserve that's trapped. They can't raise rates to fight inflation without bankrupting the government through interest expenses, but they can't cut rates without reigniting inflation. They need a way out, and the way out is Plaza Accord 2.0. The rate check on Friday was the signal that the decision has been made. They're going to crash the dollar. They're going to devalue it by 30% to 50% over the next 18 to 24 months. Why? Because it's the only way to make the debt sustainable. If you devalue the dollar, you devalue the debt. You pay back your creditors, China, Japan, Europe, in money that's worth half as much as when you borrowed it. It's a soft default. It's theft, but it's politically palatable theft because it happens slowly, and most people don't understand what's happening. And this is where silver comes in. This is why the manipulation is intensifying. This is why they're fighting so hard to keep the price contained, because silver, along with gold, is the most visible, most liquid alternative to the dollar. When people lose faith in the currency, they buy gold and silver. It's been that way for 5,000 years. And right now, as the Fed prepares to deliberately destroy the dollar, they cannot afford to have gold and silver prices screaming higher and alerting the public to what's happening. Think about the optics. If the government announces a coordinated currency intervention to weaken the dollar and gold is at $6,000 and silver is at $200, everyone knows what that means. It means the currency is being debased. It means inflation is coming. It means your savings are about to become worthless. The public panics. They rush into hard assets. The dollar crashes harder than the Fed intended. They lose control of the narrative. But if they can keep gold and silver suppressed during the initial phase of the devaluation, if they can keep people believing that everything is fine, that this is just rebalancing or helping American competitiveness, then they can manage the collapse. They can boil the frog slowly. By the time people realize what happened, it's too late. Their dollars are already worthless. This is why the silver manipulation yesterday was not just about shaking out over-leveraged traders. It was about sending a psychological message. It was about creating fear and uncertainty. It was about making people think, maybe silver isn't the safe haven I thought it was. Maybe I should stay in dollars? It's psychological warfare in service of a broader monetary operation. But here's the critical insight. The manipulation only works on the paper market. They can dump unlimited paper contracts on the COMEX and create these violent price swings. But they can't create physical silver. They can't print ounces. And the physical market is telling a completely different story than the paper market. Physical premiums are at historic highs. Dealers are sold out. Delivery times are extending. Asian buyers are paying $25 to $30 over spot to get actual metal. This tells you where the real price is. The paper price of $102 or $117 or $112 is fiction. It's a number on a screen controlled by algorithms and manipulation. The real price is what someone will pay you in cash for a physical coin, and that price is much, much higher. This bifurcation between paper and physical is the death rattle of the manipulation regime. It's proof that they're losing control. In a functioning market, paper and physical prices converge because arbitrage traders buy the cheap one and sell the expensive one until the prices match. But when physical premiums are 20% over paper and they're not converging, it means the arbitrage is broken. It means there's not enough physical metal to fulfill the paper contracts. It means the paper market is a fraud. And this brings us to the end game. At some point in the next 12 to 24 months, probably sooner, there's going to be a delivery default on the COMEX. A large institutional buyer is going to stand for delivery, demanding physical metal against their futures contracts, and the exchange is going to fail to deliver. They'll offer cash settlement instead. They'll say, we can't give you the silver, but here's the dollar equivalent. And at that moment, everyone will realize the paper market is worthless. The price of physical silver will explode as confidence in the paper contracts evaporates. When that happens, the people who held physical through all the volatility, through all the manipulation, through crashes like yesterday, will be rewarded beyond their wildest dreams. And the people who got shaken out, who sold at 102, who gave up because the volatility was too much, will watch from the sidelines as silver goes to $300, $500, maybe higher. This is why holding is so critical. This is why you cannot let them shake you out. Let me give you a specific tactical framework for navigating the next few weeks and months. Because based on the patterns I'm seeing, based on the macro setup with Plaza 2.0, based on the delivery tensions in the physical market, we're entering a period of extreme volatility that's going to test everyone's resolve. First, expect more violent washouts. The pattern we saw yesterday is going to repeat. They need to keep shaking the tree because new buyers keep coming in. As more people wake up to the dollar debasement, as more people hear about $36 trillion in debt and currency wars, they're going to try to buy silver. The banks need to discourage this. They need to make silver seem risky and scary. So every time we make a new high, expect a vicious reversal. Silver hits $120, watch for a dump to $105. Hits $130, watch for a dump to $115s. This is the playbook. Second, these washouts will happen at predictable times. They usually occur during the New York trading session when American retail is most active. They usually happen right before or right after major economic data releases when volatility is high and people are on edge. They usually happen on Friday afternoons when traders are closing positions for the weekend. If you know the timing, you can mentally prepare. You can tell yourself, this is expected. This is manipulation. I'm not selling. Third, the recovery will be fast. Notice that yesterday's crash from $117 to $102 took 3 hours, but the recovery from $102 to $111 took less than 5 hours. The sell-off is always sharper and more violent than the recovery, but the recovery always comes. This is because the underlying bid, the real demand for physical metal, is stronger than the paper selling pressure. Once the manipulation ends, natural price discovery reasserts itself. Fourth, use wide stops or no stops at all. If you're trading with leverage, which I don't recommend, use stops that are at least 20% below your entry. Yes, that means you might take a bigger loss if you're wrong, but it also means you won't get taken out by manufactured volatility. If you bought at $150 and you put your stop at $92, yesterday's move to $102 didn't touch you. Your position is fine, you're participating in the recovery. But if you had your stop at $110 like most retail traders, you got taken out at the worst possible price, and you're not in the trade anymore. Fifth, accumulate on the dips, don't sell on the rips. This is counterintuitive for most traders. They want to sell when it's high and buy when it's low. But in a manipulated bull market, that strategy gets you killed. When silver rips to $117, that's not the time to sell. That's the time to hold and prepare for a potential shakeout. When silver crashes to 102s, that's not the time to panic. That's the time to buy more. You're buying what the weak hands are selling in fear. You're accumulating from scared retail at artificially suppressed prices. This is how wealth is transferred. Sixth, focus on physical, not paper. If your whole thesis is that the monetary system is breaking down, that currencies are being debased, that we're heading into a Plaza Accord style reset, then why would you bet on that thesis using the same paper contracts issued by the institutions that are causing the crisis? It makes no sense. Paper silver can be settled in cash. Paper silver can be manipulated. Paper silver has counterparty risk. Physical silver has none of these vulnerabilities. Yes, physical silver has premiums. Yes, it's less liquid, but it's real. And when the paper market breaks, the physical will be worth multiples of what you paid. Seventh, ignore the financial media. CNBC, Bloomberg, the Wall Street Journal. They are not going to tell you the truth. They're going to tell you that silver crashed because of profit-taking or technical selling or reduced industrial demand. They're going to give you every explanation except the real one, which is manipulation in service of protecting the dollar during a coordinated devaluation. If you listen to them, you will be confused and scared. If you understand the macro game, you'll be confident and positioned. Eighth, think in years, not days. The move from $20 to $200 is not going to happen in a straight line. It's going to be choppy, violent, terrifying at times. There will be days like yesterday where you question everything. There will be weeks where the price goes sideways and you wonder if the bull market is over. But if you zoom out, if you look at the monthly chart instead of the hourly chart, the trend is undeniable. We're going higher. The only question is whether you can stomach the ride. Now let me address the elephant in the room. Some people are asking if they can manipulate the price down whenever they want, what's to stop them from keeping silver at $100 forever? What's to stop them from just endlessly suppressing it? The answer is physics. They can manipulate the paper price, but they cannot create physical metal. And at some point, the physical market overwhelms the paper market. We're seeing early signs of this now. The premium between paper and physical has never been this wide. Delivery delays have never been this long. The COMEX warehouse inventories are at historic lows. The amount of silver eligible for delivery is a tiny fraction of the open interest in contracts. If even 5% of contract holders stand for delivery, the exchange will default. The manipulation is living on borrowed time. And the macro forces are too strong. Central banks are buying gold at record rates. They're dumping dollars. The BRICS nations are building alternative payment systems. The Fed is trapped by debt and has to debase. These are tectonic forces. They're not going away. The banks can create temporary price volatility, but they can't stop the plates from shifting. Think of it this way. Imagine there's a beach ball underwater. The banks are pushing it down with both hands. They're using all their strength, all their resources to keep it submerged. But the ball wants to rise. The buoyancy, the natural force, is constantly pushing up. They can hold it down for a while. They can even push it deeper temporarily. But eventually they get tired. Their grip slips. And when it does, the ball doesn't just rise to the surface. It explodes out of the water from all the pent-up pressure. That's what's going to happen with silver. So where do we go from here? What's the roadmap for the next few months? Based on everything I'm seeing, here's my assessment. In the very short term, the next 2 to 4 weeks, expect continued volatility. We're in the consolidation phase after breaking 110. The market needs to digest those gains. We'll probably trade in a range between $105 and $120 with violent moves in both directions. This is healthy. This is normal. This is the market shaking out weak hands and building energy for the next leg. In the medium term, the next 3 to 6 months, I expect silver to break out of this range and make a run at $150. The catalysts will be increasing physical shortage, rising inflation data, continued central bank buying, and most importantly, growing awareness of the Plaza 2.0 dollar devaluation plan. When people realize what's happening, when they understand that their dollars are being systematically destroyed, the rush into hard assets will accelerate. $150 is not just possible, it's likely. In the longer term, the next 12 to 24 months, I think we see $200 to $300 silver. This is when the paper market breaks. This is when the COMEX defaults. This is when physical and paper prices completely diverge. This is when governments implement capital controls and potentially confiscation schemes. This is when the monetary reset becomes undeniable. And at that point, pricing silver in dollars becomes almost meaningless because the dollar itself has lost credibility as a unit of account. But here's the most important thing I want you to understand. The price target doesn't matter. Whether silver goes to $150 or $200 or $500 is irrelevant compared to the bigger picture. The bigger picture is that we're living through a monetary system transition. The 50-year experiment with pure fiat currency that began in 1971 is ending. It's not ending smoothly. It's not ending rationally. It's ending with currency wars, competitive devaluations, inflation, and ultimately a reset where the rules of the game change completely. In that environment, holding physical precious metals is not about making a profit. It's about survival. It's about having a form of wealth that exists outside the banking system, that can't be frozen, that can't be devalued by a keystroke, that will hold value as paper currencies collapse. Everything else, stocks, bonds, real estate, has counterparty risk or jurisdiction risk or currency risk. Gold and silver are the only truly sovereign assets an individual can own. So when you see a day like yesterday when silver crashes from $117 to $102 and you feel that pit in your stomach, that fear that maybe you made a mistake, I want you to remember this. That fear is exactly what they want you to feel. That fear is the weapon they use to steal your position. And the cure for that fear is understanding. When you understand that these crashes are manufactured, that they're temporary, that they're actually opportunities, the fear goes away. It's replaced by confidence. And that confidence allows you to hold through the volatility and ultimately win this game. The reset is coming. The dollar devaluation is beginning. The physical silver market is breaking away from the paper market. And the only question that matters is whether you're going to be positioned correctly when the music stops. Hold your metal, ignore the noise, trust the process, and I'll see you at $200.